Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Michael Romer. He is managing partner at Romer Debbas, a boutique New York City real estate firm. We're going to discuss why rates need to come down a bit to reignite the housing market. It's great to see you as always. Welcome back to Trade Talks.
Great to see you, Jill. Thank you again for having me. Always a pleasure.
Thank you. And 70% of mortgages in the U.S., they're locked in at less than 4%. So logic would tell you that rates need to come back to the 4 or 5% level to keep this market moving, or reignite it at least.
Yeah, this is what we're seeing in the mortgage market throughout the country. Everybody who wanted to refinance did. So people that are sitting locked in at 3 to 4% interest rates, they're not refinancing anytime soon. And now when you're looking at interest rates 5.5% to 6%, the incentive just really isn't there. And that's impacting not only refinances, but it's impacting the purchase market. And sadly, across the country, we're seeing a lot of layoffs in the mortgage sector in terms of banks laying off and folks that are in the residential banking industry. It's really a tough time. And I think what we really want is that stabilization, getting rates back down to that 4 to 5% range.
Right. Well, I think there's also a number of factors at play here too. If you are locked in below 4 or 5%, do you really want to sell? Because what are you going to finance at? And then the second thing is, housing's become really unattainable. I mean, prices skyrocketed. It's, affordability is an issue as well, I would think.
Well, the key issue in this country right now is housing affordability. We really do have a housing affordability crisis. It's too expensive. And there's a lot of factors at play here. We have inflation, which is artificially increasing the value of real estate. And then we have the interest rate hikes, which are increasing the interest rates. So if you think about it from a buyer's standpoint, prices are going up, mortgage rates are going up. How can they afford it?
Yeah.
And then you mix in the housing shortage where there's just not enough housing inventory throughout the country. And it's really a problem for buyers.
Yeah, I mean, even if you go up 1/4 or 0.5%, that makes a big difference in the monthly payment. I mean, it sounds like, what's another 0.5% spread over 30 years? Well, it can make or break. My question to you, though, is, 5-6% from a historical perspective is somewhat in line. Is it because it was how rapidly they were increased that was the shock to the system?
The concept of too much too soon comes to mind. If you look at a couple of years ago, I took out a 30-year fixed mortgage 2 years ago, 2.95%. So they've effectively doubled in such a short period of time. That will negatively impact any real estate market, no matter what. It's just too much too soon. It was aggressive interest rate hikes, obviously meant to offset inflation, but the end result was higher mortgage rates and also higher expectations on the part of sellers, which has really impacted pricing across the board because a seller feels that their property is actually worth more than it might be.
Right. So do buyers have the advantage at this point?
Well, no, the buyers actually are having an affordability problem.
Right.
The buyers that have the advantage right now are the liquid buyers that actually have cash in their pocket and are willing to buy. So most transactions we're seeing here in the residential market are actually cash transactions. The number of buyers that are actually purchasing with mortgages is less currently. And that will come back, but right now it's the lack of stability because nobody knows when the next rate hike is coming and folks are waiting to see what the new normal is. But to your point, back years ago, 5 to 6% is a great interest rate.
Right.
It's just not great right now.
Yeah, I bought a house the same time as you did.
Yeah.
2.875, I think, is my rate. Not that I'm looking to move anytime soon or ever after going through the moving process, but you had to go in either all cash or a lot done or move or go in, go offering full price. I've noticed a lot that you're seeing cuts in prices now. Nearly everything, there's a cut that you're seeing. I'm wondering if that's sellers coming to terms with reality. And it's not that they're desperate to sell, but the price just didn't make any sense in the market?
If a seller truly wants to sell in today's market, the price reduction was a must because buyers were reaching a point that they were effectively priced out. Except for that liquid cash buyer that had the actual funds to buy the property, those that needed financing, they were waiting for the prices to drop. They just are starting to. Obviously, every market is different. Here in New York, we're starting to see some reductions in the last few months. The question is, are we past the bottom? You probably heard CEO of Compass, Robert Refkin, recently saying in the media that he expected that Q4 of last year was the bottom of the market, and he's predicting the market to rebound. Right now, we're waiting to see if that's actually the case. Our hope is yes. My feeling, if I've learned nothing over the years, it's never make any predictions in January because you just don't know.
Right.
And we'll see it, but I am optimistic. I think we're turning the corner. We're starting to see an increase in volume in the office.
Are there any segments that are kind of immune to it, like 1 to 3 million in the city? Because that's always a very dense category. Are there any areas that are immune to this?
1 to 3, the under $3 million range in the New York City market is somewhat immune. It's not fully immune because the buyers that are impacted by this, maybe they felt they could afford that $1 million unit with the mortgage rates, then they realize, well, maybe I can't. So it's not necessarily immune, but the $1 to $3 million apartment range here in New York City is not struggling. The demand is there and the inventory is moving. On the higher end, that's where you're seeing the greatest reductions. And those wealthy, sophisticated buyers that are coming in, they're realizing now that they could actually get the deal that they want.
Yeah, which is so interesting because I think it would have been the opposite, right? Like if $1 to $3 million, you have to do a lot of budgeting and that. But look, if you can afford a $60 million penthouse, are you really worried if? I would imagine a lot of them come in with a decent amount of cash.
Yeah, it's true. Nobody feels bad for the $60 million buyer. But I will tell you that those that are sophisticated, they were waiting. There was a lot of cash on the sidelines, a lot of liquidity on the sidelines waiting for the prices to come down because nobody ever wants to overpay, and no broker ever wants to advise a buyer to overpay because that buyer will come back and say, why did you let me do this?
All right. Appreciate the insight as always. Thanks for joining us on Trade Talks.
Thank you, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.